Hey guys, this is Mike DiCarlo. Welcome to Mic'd Up with Mike. This is episode 1. I'm so excited to have my first guest, my good friend Tommy Trauger. He's a wealth manager down in Newport Beach, and he's going to explain some of the best tax strategies and investment strategies that investors can use and applicate in their daily life. Tommy, why don't you introduce yourself a little bit and tell us a little bit about yourself?
Thank you for having me.
Yeah.
This is episode 1.
Episode 1.
Very generous of you.
Yeah, the first and foremost. And I've been waiting for a long time to find the right guest to kind of kick off my podcast.
Yep. I've
been planning it for a long time. And, once we were talking the other day about how, investing is so important and how, high level finance and using tax strategy is the next level in building out my business.
Right.
When we were talking about that, I was like, this is the first episode. It has to be.
Yeah.
Because what I want out of this podcast is to deliver, high-end advice for people that are trying to build out businesses, entrepreneurs, and flippers just like myself. So why don't you introduce yourself, tell us what you do, on a daily basis, how we met. And
Absolutely.
Yeah.
Well, it's funny. We met through our wives, actually, even though we went to the same college.
Yeah.
That's fun. So my day job, I do a couple different things, but during the week, I am a wealth manager.
Yep.
It's my job to help people basically take all of their resources and align them as best as we possibly can to generate passive income.
Yep.
And of course, over time, you're going to see price appreciation.
Yeah.
Right? Especially as money continues to be printed over and over and over again in this country.
That's crazy, huh?
But yeah, up until now, it's been a function of really holistic wealth management because it's not so much just about making $1 worth $2.
Yep.
It's protecting that money.
Yeah.
Estate planning, right? So what happens to the next generation?
Yeah.
Well, we're about to go through one of the biggest wealth transfers in our country. And a lot of folks aren't buttoned up in that capacity. That's one of the tools that we use is estate planning. I'm not an estate planning attorney.
Yeah.
But we work with several that help us align, folks' wishes.
Yeah.
Tax planning is another humongous one, which obviously is the reason why we're here today.
Yeah, for sure.
And the kind of the fourth pillar that we like to say of the house is insurance, right?
Yeah.
So planning for the inevitable. Unfortunately, no one lives forever.
Yep.
But there are really smart ways to leverage, not only protect your wealth, but kind of leverage someone's life.
Yeah.
So that's in a nutshell. Everyone's case by case. There's no really cookie cutter way to do what I do on a daily basis. Yeah. But like you were saying, when you kind of kick-started the thought of, well, here's what I do, and this is kind of my process, and I've generated a lot of cap gains over the years.
Yeah.
And it's become a burden.
Yeah.
You kind of get to this point where how can I be smart about thinking about the taxes that I pay?
Yeah.
There's a strategy you have to buy. There's a strategy you have to flip. You have a hell of a network.
Yeah.
But then it's like the back end. No one really thinks about how can I adjust? Maybe I can tweak the way my resources are allocated.
Yeah.
To really start benefiting from the back end. Right.
This is something we were talking about. It's like as I'm building my business, it was just me as a solopreneur trying to flip as many homes as possible, do all the sales, and kind of fill all the roles as much as I could. And, after talking with Tommy, he kind of enlightened me. It's like, hey, that next step, yeah, great, build a team, get your department set. That next step you need to take is how do you preserve your capital after you make it? How do you minimize one of the largest expenses you have on your income statement, which is your tax burden? And, a lot of smart people spend a lot of time developing a tax strategy. So it was so great that you kind of, prodded me to be like, hey, you need to start thinking about this now that you're building out your business and take it very seriously. So I'm about to start what we're about to talk about, and I'm going to do it strategically, but why don't we dive into kind of what we're here for? And I know as an investor, when I'm investing in things like flips and I make a lot of money, I know I'm going to pay short-term capital gains tax on that, and that is the maximum rate you can pay. on any type of, I'll say gain. So all these investors are trying to find a way to minimize that. And not everyone has rentals. Not everyone has depreciation or the money for that. But what people can do is move some profit or move some investments into what you're going to talk about today, which is direct indexing tax loss harvesting. It's a mouthful, but we're going to break it down.
We can break down each of those, components.
So
right?
Why don't we start there? First and foremost, I'm a flipper. I'm making money, and I want to put it in a fund, an investment. Talk to me about direct indexing because I know Warren Buffett says follow the S&P and leave it alone.
Right.
So I've always been, in my IRA or anything I'm doing, I kind of just follow, I try to do some indexing on the S&P, but why don't you just explain what direct indexing is, and we'll start there.
Sure. So, if you remember, let's say back in the 80s, mutual funds, right around, Vanguard, Fidelity, they're now humongous behemoths, right? And so they created the ability to effectively buy an index. Right. So to your point, what's your best bet for your first 10, 20, 30,000 bucks? Yep. Yeah, I mean, I would make the case that just simply owning an index and kind of buy and hold
and that's where I was at.
Is a good place to be.
Yeah.
You get to the early 2000s, you're now in exchange traded funds.
Yeah.
So you take the human element out of a mutual fund, right?
Yeah.
You take the
the human element real estate here.
You basically take the boardroom out of it when you had an ETF, an exchange traded fund, which is simply a way to take a basketed approach to buying an index.
Right.
So to your point, I mean, you can go out and go buy an S&P index, a NASDAQ index. You can, I can't even tell you, I think there are tremendous amount of more products than there are stocks that exist in the universe right now.
I've seen them all.
So then that was early 2000s, and that's indexing, right? You take it a layer further. This is now we're talking kind of, early 2000s, when the direct indexing actually started at its infancy. Yep. So what a direct indexing strategy is, so let's peel off the tax loss first and just talk about direct indexing. There's 504 or 505 stocks, believe it or not, in the S&P 500.
Right.
Why? Well, because there's some of the shares have two different share types. Right?
I see.
If you can go in, you actually don't have the ability to directly own all of the components inside of the S&P 500.
Right.
So it's market weighted, right? Yep. So as the sizes of each of these companies move, the relationship that it has against its index in total will be changing periodically. So what this strategy does is effectively it attempts to and does a hell of a job at it to mirror the S&P as its individual components.
Right.
So just give you an example. Right now we're in a infotech phase, right? You have 7 to maybe 10-ish companies that are driving about 30% of the returns in the S&P 500.
Wow.
And this isn't, we're in a cycle, right? I think technology is here to stay. But what I'm getting at is if you were to own the S&P 500 index in an ETF, we couldn't be smart about selling the info technology sector inside of your ETF. Why? Because you bought the ETF as a basket.
Yeah.
I can't say, well, 30% of that ETF is infotech. I'm going to sell a third. I'm going to sell a portion of it, right? A little slice of the pie. It doesn't work like that.
Yeah.
So this is where direct indexing came in, and you can actually now isolate. So you can own effectively mirroring the S&P like we had initially intended to do.
Right.
Okay, so that's direct indexing where you're owning it's not all 500 companies. There you can get what's called your tracking error, which is a complex term for how close are you to the benchmark. Right? Yeah. Obviously, we want to track the S&P as best we can.
Sure.
It's within 1%, very very close, right? So and we have data on on all of that. But the idea there is, let's say, as we've seen just recently, the technology space has kind of sold off, right?
Yeah.
Valuations were super, super high. And, there's a lot of skeptical things going on in the country right now. And that's going to cause a lot of volatility in the higher priced area of the market. And that's technology.
Yep.
So is that helpful? Is that give you
that's
a
helpful.
good insight into what direct indexing is?
So basically you're mirroring the top 500 companies in the S&P, which is what is it comprised of.
Right. So we've moved from, the mutual funds of the world. Then we moved into this exchange traded fund world, which is still an excellent space and will probably be here for a long time. The direct indexing is kind of the next layer of the onion, if you will. So now if you want to go ahead and ask, that tax component.
So I think what everyone wants to know is how do I make money and then take losses at the same time? How do I save on my tax bill?
Right.
That's going to be a pressing question. I get it all the time, and they go, "Well, how do you make so much money flipping, but it's all taxed at the highest rate?"
Right.
So what do you do? And I go, "Yeah, I have a couple rentals, and I depreciate this, and I do that." Right. And people are with me on that, and a lot of people do that. This is another way that I think is I'm going to start doing immediately that I'm very interested to understand. So when we were talking about it originally, you said, let's mirror the S&P. Great, understand that, right? Yep. It's like I want my returns to mirror what the market's bearing, basically. Right. Now, what's different about this new account, basically, or fund, or what do you call it? Is it a fund? Is it an account?
It's either or. Yeah. It's an account, and what happens is, what's under the hood is what's important, right?
So how do I achieve returns on my money, and also get the tax benefit of, I guess harvesting losses? So why don't you dive in there, and try to keep it plain for everyone so we understand it.
Yeah. Well, stop me if it's not plain.
No, you are. But let's try to, I want to keep it simple, but also dive into the detail too, because I think it's super important.
That's the nuts and the bolts of it.
Yeah.
Right. So right now, so let's just step back and look at an ETF.
Yep.
If we were trying to, obviously, I guess I could step back a little more. Let's say you have a piece of property, you sold it, and you got, let's call it $50,000 of cap gain.
Yep.
Over the course of maybe 6 or 9 months, something like that. So, okay, we have $50,000 of gain. Obviously, having the strategy working behind the scenes is what's important, because I can't anticipate when the market goes down.
Right.
No one can really anticipate when it goes up. Right. Especially in the short term. No sense in trying to market time. So I think what's most important about direct indexing is that you do own the individual security. And what that allows you to do is, going back to my example, we own 250 to 280 companies. It can give or take, inside of there to track the S&P. But now when you have, call it between 5 and 20 companies that, because of the sector, is performing poorly.
Yeah.
We can go in and be very selective and say, well, oh gee, Exxon's had a horrible month.
Yes.
And we owned what would have been the same amount in the S&P to mirror its performance. But what we did is we just capitalized, let's say we capitalize on that loss when it say has bad earnings.
Yep.
Or there's just there's bad news out or bad media out about the company. Well, what do we do? Well, let's say we capitalize on a few $100s, maybe in some cases $1,000 in loss. Mm-hmm. But what we're doing is replacing. We're not sitting in cash.
Yeah.
We're replacing Exxon's position with another like-to-like company that's going to be highly correlated inside of that. There's 11 sectors in the S&P.
Right.
Energy being one of them. We're putting in, say, a Chevron.
Yeah.
And so what we just did is, okay, well, we reaped the benefit of, as crazy as it sounds, Exxon going down in price, but we're putting those proceeds right back into the pot in Chevron,
in a similar
company that's very highly correlated.
Yeah.
So now,
so
not
that's
only
the stroke of genius.
So exactly. So back to our point, $50,000 in gain in the property,
Yeah.
right? 6 to 9 months. Well, now there's just one simple example of the energy sector slowing down, us taking advantage of decline in the market, and not sacrificing investment performance because Exxon and Chevron are like this.
Yeah.
They're in tandem.
So you get back into the position, but
get
with
right
a different
back into
company that's
with a different position.
highly correlated.
And can I go one layer further real quick?
Let's do it.
So that's tying, that's basically keeping your performance like to like, right? Keeping the same dividend, right?
Yeah.
Energy sector, there's a lot of companies in there that pay a good income. Let's take it a step further. So an exchange traded fund, if we were to try to do the same strategy, you sell an S&P 500 company or S&P 500 fund, sorry. To try to replace that company, you have to go finding, a like-to-like
Performer.
S&P, call it a Vanguard fund versus a Fidelity fund or whatever it is. There's a wash sale rule in the tax code that basically says if you sell, one of these S&P 500 funds and replace it with another S&P 500 company fund, what you're doing is you're selling something that was effectively identical to the one that you just sold.
Right.
And the IRS says, well, why on earth would you be able to reap that benefit if you're just selling and buying back the exact same thing? So fast forward to what this strategy does, selling Exxon in the previous example and going right back into Chevron completely eliminates the wash sale issue, right?
Right.
Does that make sense?
So
that's actually the magic in this.
There's a couple layers here. One is the direct indexing, right?
Exactly.
And you're able to break it up and mirror it with the individual companies versus a big basket of them. That's the first part, right?
That's it. Yep.
And then being able to sell that company at a loss and capture that loss, which will offset something like my flipping income.
Correct.
So I'm not showing maybe any gain.
Well, flipping gain,
Flipping gain.
Yep.
And then buying back into a similar company and keeping my position.
Yep.
Basically the same position, but now I'm still tracking with the S&P 500 because I'm just moving my money over to a like stock.
That's exactly right.
So that is mind blowing,
so,
and that's why I wanted to talk about it so heavily because
Yeah.
I could be using my money to make me more money and track the S&P while also harvesting these losses and offsetting my gains with my flipping, which is just, it's next level. It's really high level, and I can't wait to get started because I think we're going to go through maybe a graph
series.
and a couple examples of how much, as a percent return that the S&P did.
That's right. Yeah.
Which is amazing. It did amazing, right?
Well, just a quick statistic, if you don't mind.
For sure.
Going back to this, I'm going back to 2001. Over 80 to 90% of the companies in the S&P 500 experience some level of negative return.
Right.
Over every year.
For sure.
So, of course we want the price to go up in the stock market every year. And of course we want the dividends and income and everything to compound on itself. Well, that's standard.
Yeah.
That's what happens as, more dollars and corporations grow their returns. That's going to continue to happen.
Right.
This approach is kind of looking at what you are capable of when we have a downturn.
Yeah.
And so to give you an example, there's between, I'm just looking at my charts here. I mean, there's about 75 to 80% of the companies in the S&P experience a 5%, at least a 5% negative return at some point during the year. So think about that.
Yeah, that's crazy.
So there's 11 sectors in the S&P, right? Like we talked about. So apply that same concept about the energy sector to consumer staples, consumer discretionary, infotech, right? And so that's kind of, I think that's an important number. So that's what I wanted to share with you. Yeah.
Yeah. I mean,
opportunity. It's every year.
Yeah.
Right. This isn't wait for a COVID pandemic for stocks to sell off 30% and say go. This is a passive strategy that can be applied to real estate activity time and time again.
Yeah. So basically throughout the year, some of these stocks are taking losses.
Right.
And you want to be able to capitalize on that.
That's right.
So if you don't sell them, then you don't realize it.
Right.
So what they do is throughout the year, they're tracking it through the year, finding the best losses to take, taking those losses so you can offset them on your return, and then buying a similar company so you keep the same position you had and track the S&P.
That's right.
It's fantastic.
That's right.
It's really a stroke of genius, and I don't know who got together and made this thing up, but it sounds like one percenters.
Yeah. Well,
sounds like a one percenters thing.
Right.
And it sounds, like you explaining it to me and kind of bringing it to light, which I hope to do with this podcast, is kind of bring it to the masses and say, hey, hold on, this kind of thinking needs to be used by everyone running a business or everyone that's investing, because you're just leaving so much money on the table, paying it to the IRS, paying it to the government, when you could be investing it, making a return on it, while also taking the losses on it, which is a phenomenon I didn't know you could possibly do. I know that's why they created the wash rules, so you couldn't do stuff like this.
Right.
But now this direct indexing, which allows you to take the companies and find a different company, but it mirrors it exactly in terms of return, is just honestly fantastic. I don't know other word to say it. It just
it's very granular.
Right? It's granular and for sure.
But
that's an understatement. But But that's why you need to be talking with someone like yourself that you're in this every day. You're day in, day out, you're in it. And I wouldn't have known about it. I don't know what this is. And so I was just putting my money in the S&P 500 funds, right? Tracking the return. But I was missing out on all these tax advantages.
Yeah. Well, so let's just, let's just say you are you got the 20 or 30,000 bucks in the S&P, and in fact, there is a minimum obviously to run this strategy. You can't, in order to make this work, think about it. We have to own 250 to 280 up to 300 companies sometimes. To move the needle, you're going to need 250,000. But it really starts there because you are getting this isn't something you can't get cute with this. It works because of that's kind of the number that we came up with that where it makes can sense make an impact. But to your point earlier, I really love you're right. This was a 1%er strategy.
This is 1%er type
and
stuff,
and it's now to a point where thanks to trading advancements, technology advancements, that we can provide these types of things to kind of mid-tier, operations, right?
Yeah. I mean,
to someone like yourself, to flipping, whether that's 10 flips a year, 2 flip, 5, 20, 50 slip, however.
Anyone that's making a decent amount of money in their investments or their business that involves investing should be thinking about this. That's the bottom line. I mean, whether or not you 250,000 plus, that's fine. So this is kind of an intermediate, like next level, taking your business and strategy to the next level kind of thing. Probably not for the guy that's doing one flip a year. That's what I'm hearing. But probably more for maybe an advanced flipper or an advanced investor that's
for now
trying to build out.
Yeah. So that's, going back the next layer, the next
next layer is bringing it even
to how much more granular can it get? Well, then it's kind of diminishing returns at that point, right? So,
for sure.
So, and I don't know if you wanted to talk about the kind of the S&P during, our favorite 2020 year, obviously with COVID.
Why don't we go now that we kind of know what this is?
Yeah, sure.
Why don't we jump to your charts, because this kind of this is what you showed me the first time that we were talking about this, and we'll try to keep it as simple as possible, but just highlight what the fund was doing, and then what was the gain on taxes that people that are just doing an S&P fund weren't capitalizing on.
Right. Well, the I guess let's just step back. So the S&P during 2020, obviously, during March, everyone was up in arms. No one knew if tomorrow would happen. And because of that, there was a tremendous opportunity that we saw, in the S&P in March. If you may or may not remember, we were down as much as 28-30%, I believe, in about a month and a half.
I remember.
So, right?
Yeah.
Checking your phone every 5 minutes.
Yeah.
Like what is money
out,
anymore?
Tripping out, yeah.
It's like you're talking in gold bars now.
Money's just money.
Yeah,
it's unimportant.
Yeah. But no, I mean, I'm just looking. So let's see. We had about 12 to 15 trades over the course of 2020 that allowed us to capitalize on, I'm going to use for illustrative purposes, $1 million to start.
Sure.
And on Jan 1, right? So you had $1 million in the portfolio, and you let this strategy, the direct indexing strategy, run its course.
Okay.
By March, mid-March, we had already realized $96,000 of losses.
Wow.
Okay. Now, of course, you saw price decline.
Right.
But what happened, right, over the course of the rest of the year? The S&P was able to, we were up 18.2% or thereabouts,
right.
Holding on. So by the end of the year, so there was volatility in May. We had a lot of volatility in July. Kind of the sell-off in kind of November time.
Right.
By the time we got to the end of the year, we'd realized $205,000, or about 20%.
Right.
20% of your million, we've realized $205,000 of losses, and just staying the course in the S&P, we had gained about 18%. So your ending portfolio value that year was $1.18 million.
Wow.
And simultaneously had realized $200,000 of loss.
Right. So in your portfolio, you had how much was the gain? 18% gains in your portfolio.
Right.
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 So
just
sitting there.
Yeah.
And then another 20% you've taken in losses, which I can use against my
exactly
income.
Right.
So
let's
in this example, you were talking about $200,000 on $1 million.
That's right.
Obviously, you could scale it back. If it's 100, it's 20 grand.
That's right.
But those are all. I mean, that's like taking depreciation. That's like taking other expenses that people that are not doing this strategy are losing out on.
Right.
I mean, it's crazy.
Right. So let's put this next to an example of a property transaction.
Okay.
So let's say Jan 1, right? 2020 was a stellar year, and you had a good year in the real estate market too.
Yep.
Things were booming. 2021, I think, was even better.
Yes.
But so, right? So okay, we're December 31st, 205,000 on just this year. This doesn't account for any activity that happened in prior years, right? So you can add this loss on your return to the kitty, and it just sits there, and it's prepared to be used on your activity going forward.
Right.
But so let's say, you bought a piece of property for, I don't know, $500,000.
Sure.
And you put 50 into it, right? You're in it at 550. We could go up all the way to $750, say $800,000. You're going to, in that example, you'd owe somewhere close to 150 to 200 grand, right? In taxes. Well, if we have this running side by side, those taxes that you would have otherwise paid in short-term cap gain were just wiped out from your investment portfolio.
Incredible.
And simultaneously, we made $181,000.
And unrealized is $181,000 that is tracking the S&P.
Right. So another way to think about this is, what I like to call, I was going to say this earlier, but eliminating tax drag.
Yeah.
Right. So every year, if someone in this example, like let's just try to apply this to an ETF, right? If you needed to generate cash, you're going to sell out of the portfolio, and that's going to generate a cap gain.
Yep.
Right. That would have hurt our after-tax returns. Whereas if we can sell out of this account, we've been accruing the loss throughout the year.
Yeah.
So selling at a gain no longer costs you anything.
Right.
Does that make sense?
Yeah. So you can effectively pull some of this out and not pay taxes on it as well.
That's right.
Another amazing thing that you were talking about, which I just thought was super next level, is that let's just say, people are going to say, well, that's fine, but I'm tying up my cash in this thing, which is, slightly a downside, but not really, because when we were talking, I was like, how do I get my money? You know?
For liquidity, you're saying?
Yeah.
Oh,
So,
yeah.
So when we were talking, he goes, well, here's the best thing. You put this in our fund, and then, we can lend it back to you. And so you could be strategizing, taking all this stuff and get some money back, right?
Right.
To
So
use for more flipping or whatever it is I wanted to use it for.
To your point, this is, another layer. Here we go. Another, I think we're at the fourth layer.
This is a very large onion.
Yeah. So, what Mike's referring to is what we call in our terms as a priority credit line.
Yep.
It's a personalized line of credit where you effectively become your own bank.
Yeah.
And instead of, like you mentioned, pulling money out of the Magic portfolio, out of the engine that's generating not only returns, but obviously losses, you can collateralize it. So what you're doing is basically posting up with the balance of your account.
Yep.
And depending upon the product inside of there, in this case, individual securities, most firms will lend up to 60% and sometimes 70% of the portfolio. So at 1.1 million, right? So we're talking $700,000 of lending capabilities. Now, granted, that does cost you.
Yeah.
Right. But what are you using the lending for? Well, if we're going to use it for an investment, now we have investment interest expense.
Right.
So, that talks to the tax return, which in theory helps your bottom line. So being able to, that is another layer. Now, granted, we're in a very high rate environment.
Yeah.
So you have to really make the case. In some cases, we'll do this type of strategy for a bridge loan.
Yeah.
Right. So instead of, sometimes you'll need a rehab budget.
Yep.
You got to buy the property first, and then we need a rehab budget.
Yep.
Well, instead of going through a headache of trying to go through an application process, getting the money approved, ultimately getting the proceeds here, there is no underwriting with a credit line. You have your own check.
Yeah.
And it's in your business, right? And you write your business a check, and the liquidity is there immediately.
I'm writing interest to myself.
You're writing interest to yourself.
Yeah.
And not to mention, and you can get even more creative. The portfolio obviously generates the S&P's dividend rate. It's 1.6, 1.7, somewhere in there. So there's interest being paid monthly, and you can use that interest depending upon the amount, to service the debt on your credit line that's outstanding. Right. So again, case by case.
Yeah.
Right.
This is super. Obviously, everyone's thing is different. Which,
right.
I implore people to, have a meeting. Basically, is what I would say. But it's just so cool. I really appreciate you coming and talking to us about it, because
thank you for having me. Listen, I would love nothing more than to figure out a way to have the masses participate in something like this, because there's a tremendous amount of value that sits underneath the market, right? Instead of it always going up.
Yeah. So so you can capitalize on losses while also keeping your position, and then correspondingly borrowing that money back and using it for more flips.
Yep.
I can make more than an 8 or 9% return on my flips.
Yep.
So doing that, I'm just compounding everything, which is, I think, the goal of what the goal of everyone should be. Yeah. So why don't you just tell us the name of your company again, where you guys are at, and then we're going to drop a link if you want to, set up some time to consult with Tommy, or, talk with both of us about how we're setting up this strategy and capitalizing on all the tax advantages and also making fat returns. Click the link below and feel free to reach out in DMs or, whatever you guys feel is your best way of communication. But we're going to have a link so you can directly reach out to Tommy. Yeah. So go ahead. The name of your company?
To start, I'd love nothing more than, I think this is more or less directed at folks that operate in the real estate market.
For sure.
Because of how impactful it can be on especially the gains, because when you apply leverage, like purchasing real estate, you put such a little amount down and you're responsible for a lot, right? So there's tends to be a lot of gain there, right? So there's a lot of 5% on $800,000 house is quite a bit,
Yeah.
right? Versus 5% on your down payment in the market is a heck of a lot less.
For sure.
But I mean, so we have our firm is TSG Wealth Management.
Okay.
We take our philosophy is basically, you know, guiding folks in really every facet of their life, because I can't do my job correctly if I don't know, you know, who the next generation is.
Yeah.
How the money's protected, right? And there's really no restrictions on who I can and can't work with. It's really a function of our time.
Yeah.
And we've got an excellent support staff that help. But yeah, we're down in Irvine, California.
Yep.
We have offices up and down the coast in California.
Awesome.
We've started building out offices, you know, east also.
Expanding.
But this is, no, thank you for having me. This
Yeah.
has been awesome. And I really hope that we can continue kind of giving some guidance and even direct examples
Yeah.
of folks of
what we're
how
doing.
you know, how this can offset and ultimately keep more of the, you know, your own money in your pocket.
Right on.
So,
All right. Well, I appreciate you, Tommy. And
Yeah.
then can't wait to have you back on the
Yeah.
show for another episode.
right.
And can't wait to tee it up with you again next time. That was fun today, brother. Thank you so much.
Thank you.
All right. Thanks, guys.
You should have the same in your brain like me. If you wanna taste it,